What is up, ladies and gentlemen? Welcome back to another market video. In this video, we will be covering stock market news, earnings reports, and a move that I have made in my portfolio. So without further ado, please destroy that like button for me and comment on things that you want me to cover in the future. These videos take me close to 4 to 6 hours to make, so just a thumbs up would be really cool. All right, let's get into it. So, May has been a really solid month in the past couple of years, averaging a 1.5% return, meaning it should be relatively okay within the next month short term. This is not always a must. This is just the data for the last couple of years. We've only had 1 year where we've went down, a couple of years where we have got close to nothing, which is 0%. But we should be relatively solid when it comes to returns within this next year because earnings have come out. Speaking of earnings, 25% of the S&P 500 reported this week. We're gonna cover most of these companies here, and I will tell you how good they did. As you can see, so far, we have not crashed the market this week. So everything was not too far off what we expected, which is really good because in the last video, I mentioned that we had a very high, a high expectation for earnings, and we pretty much met those expectations so far. And when the massive companies of the S&P 500 meet those expectations, it pretty much sets up the rest of the weeks. And it's usually more common that other companies are able to hit it as well. So that is pretty sweet. This is the busiest earnings week specifically because so many massive companies are reporting, as you could see here. Some quick news that I won't really be covering, but this is some quick news. Apple authorized a $100 billion share buyback. Amazon had a strong beat on their AWS, and Meta does continue to spend massively on CapEx. And we will get into the subjects further. I don't really talk about Apple in this video, though. Some macroeconomics, Jerome Powell indicated the next move could be a rate cut, even though there are disagreements. Inflation metrics hit a 3-year high in March, due to all of the Iran conflict, which is to be expected. And we grew slightly below expectations on economy. So we're not doing terrible, but we're starting to slow down. So we need to keep an eye on some things when it comes to economies measurements. We have broken a record. We're at the all-time highs right now. Semiconductor stocks on their ETF was up an 18-session win streak, which I believe is a record. Unemployment job claims have dropped to 189,000, which is a tight labor market. And AI optimism is pretty much the only thing that is, not the only thing, but one of the biggest reasons why the stock market is not just going down in this short-term period. So, first off, we have Meta Platforms. I graded them a C+ or B-. So you can see here, we have a 33% return on revenue, 35% return on cost of revenue, 46% return, or not return, but 46% raise on research and development, another 35% raise on total cost and expenses. Research development really brought that up. That was pretty much half of that. They had a couple of one-offs when it comes to taxes, and their share EPS has rose significantly. If you need more time looking at this, just pause it, compare the numbers. I rated it a C+ because the one-offs helped the final numbers, so the numbers are not as good as they seem. Research and development was up 13% over the revenue growth. You never want to see something up that much. And that's pretty much what swayed the total costs and expenses to be near 35%, which is higher than the revenue rate, which is also bad, and that is what I wrote here. The income operations is up 3% over the revenue rate. They've raised CapEx again from around 125 million to around 135 million. And the cost of revenue grew faster than revenue by 2%. So not the best here. They were definitely one of the worst reports that we've seen this week when it comes to the big Magnificent Seven. Definitely not terrible. This is not a terrible report. This is not the end of the world, but they did grow a lot when it comes to research, development, and cost of revenues, which means they didn't really grow that much over the past 3 months. And that's because they're just spending so much. And Meta's not a terrible company. They're a good company, but no one knows why they are spending so much on CapEx, right? And I'll get into the reasons why others are like Amazon and Google and why they're getting away with it compared to Meta. But let's be honest here, we're going to have a lot of short-term pain when it comes to Meta, and it might even be for years, 1 or 2 years, maybe up to 5, before we have a long-term raise back up. And the long term, Meta's not going anywhere, okay? They're still one of the best quality companies you can have. But in the short term, I do think that we're going to have some pain coming. If they continue to up these CapEx, and the CapEx already is so high that the EPS is not going to be growing, which is earnings per share, that won't be growing as much over the next couple of years, meaning our returns are not going to be as good because our numbers have lowered. And when that happens, the stock moves down. So I really do think there's going to be some short-term pain when it comes to Meta in the short term. Amazon is a A. I think I did an A minus on this one, or just a regular A. They had 11% net sales with a 70% net total sale, which is actually pretty good. 14% cost of sales, that's lower than the net sales. The only thing that they didn't do great on is the technology and infrastructure, which is their CapEx area. Pretty sure that's where they put it. It rose 30%. That is almost, that's double. So that's not great. That's why they didn't get an A plus. If they had that number controlled or contained, this would have been a fabulous earnings report. And they actually surprised me here with a negative 2% on general and administrative expenses. So they're doing good on other areas, cutting things down, or making it to where it's not growing as fast as their revenue or their sales. But they do need to watch their CapEx, because that could also probably hurt them as much as Meta in the future. A 30% raise in operating income. They had a couple of one-off on their taxes to help them. And that's also why I didn't give them an A plus. Their numbers look a little better compared to last year when it comes to taxes, even though they did get hit when it comes to income taxes, which is probably tariffs, if I had to guess. But all in all, they had a pretty solid report. This is some of the data I found on the earnings report, just for you guys to see. I mean, going up 28% year over year is actually really insane for a company that's in the billions. It's hard to find companies that consistently grow this level every quarter. But they're killing it, and they're going to continue to kill it as long as they watch their spending. But they do have results for the things that they've spent on so far. Here's another thing that they need to watch out for: their cash flow. As you can see, it's trending lower, but over the past quarter, it's gotten destroyed. And this could have been from the one-off on the income tax. This is how they probably could have kind of floated by comfortably with all the tariffs. But they could have also spent some of this money with the CapEx that they are spending on. So we might have some CapEx problems from Amazon, just like Meta has now, within the next couple of quarters. Who knows? So keep your eyes peeled on this. This is something I know investors are staring at, and we will continue to watch it. Alphabet, Google has a A minus. They did pretty well. They had a 22% on revenues and a 30% on income from operations. That's really good. That's them becoming more profitable. They do have a couple of high numbers here. They've contained a lot of these expenses, but their research and development and sales and marketing, research and development will be CapEx, I'm pretty sure, on Google's reports. They got hit with income taxes. That might be the tariffs. And they had a couple of one-offs on taxes as well that helped them. So I graded them an A minus. They were pretty good. I mean, as you can see here, their year-over-year growth is 22%, and that's not something to be sad about. So, how can Google and Amazon get away with their spending when Meta can't, right? Meta's stock price has gone down significantly ever since the news on this CapEx spending. And this is exactly why. For Google and Amazon, they can sell their infrastructure to external customers immediately, ones they already have signed up for things and ones that they can reach super fast. These investors can see CapEx as building inventory that is already generating cash, like another business. Meta, on the other hand, is going to use it only internally to improve their ad and business, which is good. That will increase their profitability, but it's more seen as a soft return instead of a hard return compared to a 63% surge in Google Cloud revenue. So this is exactly why Meta and maybe Amazon in the future, if they keep spending a lot of money and they drop what was it called? They drop their cash flow. We might be able to see this problem in Amazon, but Amazon should be steady enough to not have as big of a problem as Meta. But Mr. Zuck, he is spending a lot of money right now, and he's done this in the past. But in the long term, the business is still going to be here. What is this? This is Microsoft. Microsoft has a A minus. They have an 18% growth on total revenue. They didn't do great on cost of revenue. That outstripped their total revenue by a lot. I'm not quite sure as to why. I'll have to do some more research on that. They did good on research and development, way better than other companies. They've kept a lot of other numbers down. Operating income at 20%, and a net income of 23%. So their numbers are pretty good. If they would have been able to control their cost of revenue, A plus, right? So they had a pretty good earnings report. And now when it comes to buying Microsoft, they have a forward PE of 23 and a 2-year forward PE of 18. 18 is usually seen as low, but one of my mentors said that you can't trust the 2-year forward PE right now because their EPS is going to lower from the CapEx spending when it comes to depreciation on the chips. When you depreciate something, you can't grow, or you have to mark it on that specific earning sheet and it will affect your numbers. So you can't grow as much. So this number, even if it's low, may be tricking us right now. So I wouldn't just go all in, diving everything into Microsoft. I have a small position. I don't plan on adding a bunch to it. But they're going to be here on the long term. They're growing and they're continued to growing, and they've always grown in the past. This is definitely a opportunity for some of you guys who have no position in Microsoft. So my portfolio moves, the last thing I'm covering on this video, I decided to sell some of my Meta. I sold close to 40% of what I had in Meta. I'm expecting in the short term, around a couple of months, maybe even a year, for it to downtrend over and over while the depreciation affects their earnings, their EPS for Wall Street. And it might not. It might shoot back up. That's why I definitely left a couple of shares in my portfolio. But I did think that I might be wasting money keeping it there when there are better opportunities in the market instead of riding it all the way down. So I pulled that out of Meta. I bought some Nike shares, 6 Nike shares. This is the amount of stock that I bought. I bought some Nike, SoFi, Fubo, and Elf. For those positions, I am DCAing down. I don't know if you can see that. I'm sorry. I'm DCAing down on Fubo, SoFi, Nike, and Elf. Those are really good stocks. Be careful on Fubo. I will admit that I did make a beginner's mistake on Fubo. I was DCAing down and they did a stock split and it kind of destroyed me. But I'm just going to hold. I got strong hands. I'll hold it out and I do think that it will come back. But don't, when you're DCAing down, don't just continuously do it. Remember to watch the total amount of money that you have in that stock, and to not get too carried away from the percentage you are down. But SoFi, that had great numbers on their earnings. I forgot to include that into this video, but they had a wonderful earnings. They smashed it out the park, and they might even turn into the next Palantir. Like we're talking $50, maybe $100 in the next 5 years, something like that. So I'm really expecting a lot from SoFi. They're becoming a big bank and they have, I think, 15 million people with them. So they've grown massively over the last couple of quarters. So I put a bigger position there. Nike, they have a big turnaround story. Their numbers recently, I think close to 2 weeks ago, have gotten significantly better when it comes to turning the business around because they have been trending down. Meta, I cut some position here, and Elf, wonderful stock. It went down when tariffs were announced, and I've just been DCing down even more because I know that stock's going to turn around. So I have highlighted Microsoft and Meta to remind you guys that you don't need to go too far into these companies who have massive capex, because we're not knowing what to expect, right? When Meta spends all these billions of dollars in capex, we don't know what it's going towards, right? We know it might be a soft investment, but there's no, like, they're not very clear on what they're spending it on and how it will affect their returns. If their returns are going to double, then, I mean, the stock would be up, right? That's, at the end of the day, the stock would be up. But because there's confusion, there's no communication on Mark telling us, or Mr. Zuckerberg telling us what he's trying to do with that capex, then all of his investors are confused and the stock's just going down. I mean, it was at 800 and now it's at 610. So it's a good opportunity to start buying in if you have no position, but I do think that we're going to be going further down in the future. Just an opinion, not a fact. Microsoft, they do have rose their capex by 35 billion, I believe. And that's not the best, but they are growing on their, they have a smaller business within Microsoft that is a data center. I think it's called Azure. I can't remember, but we have absolute proof that what they're spending on is going to grow, right? And that is why Microsoft isn't down 20% like Meta is. We have proof that the chips that they're buying for this data center is going to improve their business. It's going to add a whole nother business to the side. Same thing with Amazon. They have a data center with Amazon, and that is a section of their business that we can see growing. I want to say it grew 63% this year, which is insane. But because it's growing 63%, we don't mind them putting billions of dollars to it, right? Because they're growing 60%. And if they keep that up, then it's going to be massive. Whereas Meta, we're not sure what they're doing it on. And that is the biggest thing that is affecting Meta stock, and why Meta is getting absolutely slammed compared to the other ones with CapEx. But Amazon may join them if all of the other companies continue to spend out of their butt. We might be in an interesting situation. But I'd wait for that. Ladies and gentlemen, thank you for all of you that have subscribed. That will be it for this video. I really do appreciate all of you guys. And if you would give me a thumbs up, that'd make my day. And I'll see you next time. Peace.